Welcome to Accounting Essentials, Master the Basics in 10 days. I can't believe it, but you actually stuck with me and you have made it to day 9, Ethics in Accounting. You know the drill by now. Get your flashcards and your pen ready because you're gonna wanna take notes. Don't cook the books. End of today's video, just kidding. Anyways, ethics in accounting is extremely important, and get your flashcard ready and we will go over the super boring textbook definition that I wrote. Ethics in Accounting Explained. Ethics in accounting refers to the moral principles and guidelines that govern the conduct of accounting professionals and the preparation of financial statements. Ensures that financial information is accurate, transparent, and reliable. Let's break this down. Ethics in accounting refers to the moral principles and guidelines that govern the conduct of accounting professionals and the preparation of financial statements. Moral principles such as not inflating assets, aka over-reporting assets, beefing up your balance sheet, really making your assets section look good, or deflating liabilities, aka making it look like your company doesn't owe much money by using creative accounting. We don't use creative accounting. We follow the rules at Accounting Direct. You don't want to go to jail. It's time. Ethics in accounting, the moral principles and guidelines governing accounting practices to ensure accuracy and transparency in financial reporting. Let's talk about transparency in financial reporting, meaning you are not covering stuff up. For example, let's say if your company entered in a litigation after you started your financial statements, meaning you're working on your 2023 financial statements and the year is 2024 and you entered in a huge litigation lawsuit. You want to be transparent and record in your 23 statements in your footnote section that in the year 2024, the company is in a lawsuit. Financial integrity, the quality of financial information that is honest, accurate, and free from manipulation. I'm going to say this again. Honest, accurate, and free from manipulation. What does this mean? You're not lying. And with a proper internal control system in place, it would be really hard to do. But let's say you are at a small company and you are an accountant of one. So you upload the journal entries and you approve them. Most likely this won't be the case, but let's say it is. You're honestly recording the figures. Once again, you're not inflating assets and you're not deflating liabilities. You're not overstating revenues and you're not understating expenses. And you might be like, well, why would I do this? Because your bonus is tied to net income. So the higher the net income, the higher your bonus. It's not worth it. Don't do it. Confidentiality, the obligation to protect sensitive financial information from unauthorized disclosure. So what could this be? For example, let's say you are an accountant at Ulta Beauty and you are preparing Ulta Beauty's income statement. And when you download the 10K online, which is available to the public, you can see the line of sales revenue. But you know that the reason why Ulta Beauty is doing so well compared to Sephora is because their Kylie Jenner lip kit is blowing off the shelves. And you as an accountant have a duty to not leak sensitive company information for your own personal gain. This is not Wolf of Wall Street here. Financial integrity. Ulta must accurately report its makeup sales, expenses, and profits. Falsifying financial data could mislead stakeholders and harm the company's reputation. What does that mean? Let's say the company is doing super crappy and you falsify the financial statements and all these people invest their hard-earned money and buy your stock thinking that your company is a good investment, but it's not. And then in 3 years, when it's uncovered by an auditor, people lose their savings. You don't want to be that person. Transparency. The company's financial statement should provide a clear and truthful picture of its financial health. Transparency builds trust with investors, creditors, and customers. Confidentiality. The company must safeguard sensitive financial information, including customer payment data and integral financial records. Unauthorized disclosure can lead to legal and reputational consequences. Okay, for example, let's say you're an accountant, again, at Ulta, and you're preparing their income statement, and you see that Ulta has record high income for the year, and you know that Ulta is going to be paying a dividend. So you call up your mom and you say, Mom, you better buy Ulta stock because Ulta is going to go up. No, you don't do that. The financial statements haven't been released yet. When the financial statements have been released and the public has adequate time to digest them, then your mom can decide if she wants to buy stock in the company. Ethical dilemmas in accounting. Accounting professionals, including where you may work one day, may encounter ethical dilemmas. These can include issues like recognizing revenue prematurely, concealing financial problems, or engaging in fraudulent activities. Okay, recognizing revenues prematurely. For example, let's say the sales team closed a $10 million transaction January 1st, 2025. And remember, the rules of accounting mean that you would have to recognize that revenue Q1 2025. Well, somebody comes to you with their sob story of why they need their bonus in Q4, and they can't wait till the end of Q3 to get their bonus. So they just want you to change the date from 1/1/25 to 1/31/24. Don't do it. Don't. You hear me? Don't do it. And if you're concealing financial problems, okay, so you're the baby accountant and you can see that a specific product is not doing well, and instead of letting your accounting manager know, you just cover it up. Don't do that. Not a good choice. We make good choices at Accounting Direct. And finally, engaging in fraudulent activities. I should do let me know if you're interested in a video where I could do a video on top 10 accounting scandals, because there are accountants that just cook the books. Why don't you just do a little search and check out Enron. Don't do that. Don't. For money? No, it's not worth it. Okay, so you made it to the knowledge check. What does ethics in accounting refer to? The practice of maximizing profits at any cost, the moral principles governing the conduct of accounting professionals, and the accuracy of financial reporting. Or C, the requirement to always report the highest possible revenue. The answer is B, the moral principles governing the conduct of accounting professionals and the accuracy of financial reporting. Don't get excited. Why is financial integrity important in accounting? To maximize profits, to provide accurate and honest financial information, to conceal financial problems. The answer is B, to provide accurate and honest financial information. Don't even think about covering something up, because one day when you are audited, you don't want to go to jail. It's not worth it. Finally, what is the role of confidentiality in accounting? A, to share financial information with competitors. B, to protect sensitive financial information with competitors. Or C, to make all financial information public. The answer is B, to protect sensitive financial information from competitors. Okay, it's sad to me that we even have to discuss ethics in accounting, but unfortunately, there has been accountants in the past that have not made favorable choices. So if somebody ever puts you in an uncomfortable position in accounting, I invite you to walk away. There are plenty of jobs out there and it's never worth it. And if you haven't picked up my book, Accounting Essentials, Master the Basics in 10 Days, click the link below and pick it up.